Cracking Crypto is partnered with City Index. Trade shares, CFDs, Forex, crypto and more with a trusted provider.
G'day and welcome to Cracking Crypto on a Wednesday. I'm Andrew Gagan. Great you can join us. Let's take a look at where the broader market is at the moment. Bitcoin and other crypto coins continuing under pressure. We can see there that this is investors await the next hike as far as monetary policy in the States is concerned, with the 50 basis point hike priced in for the Federal Reserve. That will be revealed tomorrow our time. Bitcoin has been down around 2% in the past 24 hours. It's just starting to push back higher again. Nonetheless, sitting at around 38,000 US. Ether at similar levels. It's below 2,800 as you can see there. We'll see whether it gains, all those coins gain any momentum, particularly once we actually get the revelation from the Fed Reserve tomorrow. All right, now if you have been watching ausbiz regularly, then you know we've just had our Cracking Crypto event earlier today. You can catch up with that at ausbiz.co/cracking crypto. But we thought you'd bring some highlights of the show, and our first session was with Ben Simpson from Collective Shift and Ryan McCall from ZeroCap as they discussed where investors should put their faith.
Yeah, so I think a stat that CNBC put out recently was 1 in 3 crypto investors don't actually know what they're doing, or they don't know what they've purchased. And I think, again, that education gap is pretty prominent in the space. But what we've seen with the on-chain data of Bitcoin is actually 65% of the total supply, so the total amount of Bitcoin in circulation, is owned by holders that haven't sold in longer than a year. And so what we're seeing is that the sophisticated investors in Bitcoin that really understand what the technology is about and its potential are actually buying during this time. We're actually seeing a lot of accumulation from those longer term holders. It's the shorter term holders, those that potentially don't understand it as much, and the shorter term, cash grab sort of investors. They're the ones that's, bought back late 2021 when Bitcoin went up to $50,000, $60,000, and eventually sold 3 months later as Bitcoin corrected. So, again, I think it's an education gap. People may be chasing the hype, chasing the FOMO of missing out on, those gains in crypto. As we see, it's one of the most volatile markets in the world. But I think it's the accumulation phase which we're seeing now, which is the most interesting for us.
Yeah, Ryan, further to that, I think it's important to draw that distinction between investing and speculation. We've certainly seen a lot of both in that space at the moment.
Yeah, absolutely. It's a really good point. The way that we think about approaching crypto as an asset class is an investment. It's not speculation, and we have seen a lot of speculative activity, particularly on the retail side. There's a lot of booms and busts in crypto, and it's very short lifespan. Those cycles tend to be very condensed, and we get these massive hype phases. You look at the Gartner hype cycle is a really good model for this. We have a lot of hype, a lot of it is media driven. Someone's got a mate that made a lot of money off crypto, and now they want to get a piece of it, and you end up getting this speculative momentum where you hit the peak of this absolute hype peak, and we're starting to come off the back of that now where we're at in the cycle. But really, investors need to take a long-term view. Look at the fundamental value of the projects they're investing in, and think about how they're going to maintain value through those cycles, and you will get real value out the back of it. A lot of these, new cryptos that are popping up will go to zero. So that's why it is important to really understand what you're investing in and think about long-term value.
Yeah, Ryan, on that point, you mentioned those new cryptos. I think last check, there are more than 17,000 coins and tokens out there. Clearly, you would say less than 1% are going to survive. To that point, how do you actually work out where there's value and the use case for a coin?
Yeah, look, it's a good question, and really people should think about it the same way that they would any other business, right? I mean, firstly, I would just say don't get caught up in the hype. It is important to really understand the technology, and it can be quite complex, but there's a lot of great resources out there that really simplify it and break it down. So I think it's important to understand what you're investing in. But as far as finding value, you know, you can have a look at the problem that they're trying to solve. You know, is this particular crypto or the project or the team, are they solving a real world problem, or are they just trying to jam crypto into a problem that doesn't really need to be solved? Have a look at the founding team, you know, their history, their background. You know, have they got the experience to be able to tackle the problem, you know, that they're looking to solve? Who are the major investors in the project? So, you know, this is similar to a kind of venture capital approach to investing. Who are the investors that have backed the project, and are they going to help the project succeed? You know, what kind of community has been built around it? And you can have a look at, you know, their forums online, their website, you know, their Twitter, their Reddit, that sort of thing. Is there much of a engaged community that's actually built around it? So all these sorts of things can indicate whether or not the project actually has legs. Of course, do they actually have a functional product is something that's important as well. And does it have users? Is anyone actually using this? You know, something that we saw 2017 is, you know, a really good example of this, where a lot of new cryptos were raising a lot of money really just off the back of an idea. They didn't have any sort of functional product. And then we had the big crash at the end of 2017, beginning of 2018, where a lot of those projects went to zero. So, you know, it really just comes back to fundamentals.
But all of that being said, Ben, is volatility something that investors should just get used to? I mean, why would crypto be immune to bouts of volatility when we clearly see what's happening in stock markets? That's why, you know, we're seeing Bitcoin and the like follow centralized exchanges and the price action there.
So I think
in
crypto markets.
Sorry.
Oh, no, you're right, mate. I think in crypto markets, we've got to look at the comparable size of the market versus, you know, let's say the stock market. So, for example, Bitcoin itself is around just under $1 trillion market cap, and, you know, all cryptocurrencies are only around $2 trillion. Now, the Nasdaq and, you know, the wider equities markets are in the, you know, the multiple sort of, you know, 2 and 3 digit sort of size of market cap. So what we see on smaller market caps is huge, you know, bigger moves, and that volatility is just due to the size of the market cap. But over time, I think as the market grows, and I think the CEO of Coinbase came out today and said that he thinks within 10 years there'll be over 1 billion people that have used crypto or you know, actively using it. And we're only about 200 million now, so we could see the market cap of crypto continue to increase to, you know, 5, 6, 10, maybe beyond $1 trillion in the market cap. And as we get bigger, the volatility will decrease. And the last point I'll say on the volatility is markets are driven by human emotion and psychology, and in crypto, because of those bigger moves, it creates even more FOMO when the markets go up and even more panic when the markets go down. So where the markets probably should trade is, you know, let's just say between, you know, a 10 or 20% move, crypto goes even further because of those human emotions. And because of the volatility, people, as I said, get more excited when it goes up and get more worried when it goes down. And that's why we see that volatility.
That is Ben Simpson from Collective Shift and Ryan McCall from Zero Cap. Well, we also discussed tech, particularly as the venture capital community continues to build in the crypto ecosystem. For their thoughts, we talked to Alyse from Future DAO and Adrian from Independent Reserve.
So, a centralized exchange like Independent Reserve is, I guess, a more traditional business. So we're a company, we're based in Australia. There are people working in our office. There's a number you can call. There's an email address that you can email us at. You know, if you have an issue, if there's a problem, you know, there's recourse, there's regulation, there are people you can reach. Whereas centralized exchange is, I guess, this, you know, slightly ethereal thing in the cloud where, you know, there really maybe aren't people that you can reach. If there's a problem, then it's really often up to you to be able to work out how to solve it. It's a slightly more complex way to engage in the cryptocurrency space. Like it may present more options than a centralized exchange is able to present, but it's really important from a consumer point of view to remember that when there's no number for you to call, that the onus is really on you to know what you're doing, to do your own research, and that the consumer protections that you may be kind of used to really aren't in place. So it's really up to you to really know what you're doing if you want to really engage in that space.
Yeah, and I guess there's a question just as far as liquidity is concerned on those exchanges at the moment, but on the flip side there, it is seen perhaps as providing greater security. Alyse, further to that, actually I might just get your opinion on DEXs, the decentralised exchanges.
So I like the fact that anyone can participate, that it's not just a central party. So even though I love independent reserve and it's very easy to use, in that I don't need to learn how to create my own crypto wallet. I do also like the idea of decentralized exchanges where I can participate, I can become a liquidity provider like you were alluding to. So I can actually create a pair. So let's just say I had USDC, and I also had some Ethereum as well, and so or Ether in that case. And then I could actually, if I have the same amount, I can actually create a pair and create a liquidity pool. And so when I provide liquidity to the market, I'm getting fees in return. And then this is where a lot of people do this, what they call liquidity farming. So just yield farming. And so it allows a lot more people to participate in the market, not controlled by any central party.
Okay, and a key to this space, of course, with the blockchain is that it is decentralised. It's cutting out the middleman. Now, talk to us then about DAOs, decentralised autonomous organisations. What are they, and what's the use case for them?
So DAOs are decentralised autonomous organisations where a group of people come together. They usually have a shared mission, and then they engage in some decentralized decision making, and they pool their capital together. So it's usually to achieve some sort of cause or mission. And some of the use cases are investment. You might want to run or create a product, service, or protocol. And a lot of these DeFi protocols actually run as DAOs. And also you could do anything such as run a country, run a university, even your book club.
All right, running a country, that might be taking a little too far at this point, but you never know down the track. There's certainly a possibility. Problems with that at the moment. Legally, they're not recognised?
In Australia, there isn't any specific legal entity for DAOs, so a lot of people have been looking overseas to create a legal entity wrapper around a DAO. So it still operates in a DAO structure. However, to provide some limited liability protection for the members of the DAO, people have been looking at different legal structures such as foundation companies that are based in, say, BVI or the Caymans, and also things like LLCs, which are the US-based legal structures. So the LLCs have been very popular because it is considered, I suppose, the non-crypto version of DAOs, in that it embodies a lot of the principles that you'd like to have in a DAO, such as flow-through entity for taxation reasons, no fiduciary duties, you don't require a board of directors, as examples.
But with the lack of, I guess, that regulation, those limits there, is it difficult for, if you set up a DAO, to actually get it moving in that, because of those legal issues, for instance, hiring staff? I mean, that's obviously going to be a problem if you don't have those structures in place.
Absolutely. So there's actually been services that have popped up to help with the traditional, I suppose, functions that you require in any organisation. So for hiring staff, usually people will have that legal entity set in place so that the company can employ the people, or perhaps usually what happens in a DAO is that anyone who's part of it is both a investor, a user, and an employee. So you have a community, and they can play all those three roles that I mentioned. So you don't need to think about a DAO as having the same functions as a traditional organization, but as a community that comes together, very much like a partnership or a collective.
It's Alyse and Adrian Shawosny joining us there. Now, of course, one for all the investors out there, picks and shovels versus tokens. How do investors choose? Or is it the tech behind the projects or in the assets themselves? For their thoughts, we're joined by Anastasia and Anagnostakos from Digital X and Annan from Cosmos and Lachlan Webb from Tracer.
I guess the answer to that would be yes and yes. They can and they should. I guess like the point of view I have from this is sort of from like a technological point of view first, that, you know, the network is sort of, the coin itself is like the servicing fee to do things on that network. And then there's all these ancillary sort of applications built on top of it, you know, such as DAOs and the whole space of DeFi, and then sort of like the data infrastructure level. So yeah, I guess like the coins and the network themselves have fundamental like technical value, but then also the applications that are built atop, like the sort of application level on top of these networks, and the sort of tokens attached to them sort of do have value, and I think that'll sort of be that'll really exhibit itself in the next few years, when I think the transition to sort of like a more decentralized world sort of like forces the legacy financial systems in particular to like adopt more decentralized, more centralized ways of being.
Yeah, because Dan, crypto economy is not just cryptocurrencies, right? It's so much bigger than that, to Lachlan's point. It's in its infancy in many ways. So it's technology really at its very basic level. So why would you potentially adopt a picks and shovels approach rather than direct investment in coins?
Yeah, look, I mean, it's, in simple terms, the greatest or the simplest analogy we can use is look at gold, right? So you have gold, which is the physical asset, and then you have the gold miners, which are the companies behind the development and mining of gold, right? So when we think about the cryptocurrency economy and sort of the evolving and growth of this economy, you now have, about 300 plus million people that are adopting to the crypto coins themselves. And then behind the scenes of that are the companies. Some of these are listed companies that are basically putting together the infrastructure to support this new economy of the coins itself. So, from an investment perspective, as an investor, you just sort of have to ask yourself, what are you after? Are you after the picks and shovels, which are basically the companies that support the ecosystem of the coins itself, or are you after the coins themselves, which they in themselves have their own intrinsic value? So if it's Bitcoin, then you are after the storage of value and the adoption of Bitcoin in the future.
Anastasia, you come at this from a different pretty unique perspective, right?
A unique perspective, as Digital X is an ASX listed company, we have Bitcoin on the balance sheet, so we fit that pick shovel category. But if we were to tell you you would like exposure to the crypto market and you want to buy into this asset class, there's no better way than actually buying the tokens themselves. Now, this can be scary for some investors because it is relatively new as compared to, say, the equity market, which has been around for such a long time, and Australians are really, really good investors, really good retail investors, but maybe less au fait with picking coins. So we're Digital X, we're a safe set of hands. We have institutional grade custody around our funds, they're wholesale funds. We have a dedicated research team for managing the portfolio. So there, like we said, to mirror what Dan said as well, it's the question you want to ask is, do you want a exposure to crypto assets, or do you want exposure to the companies? The companies at the end of the day still are very much equity based, they're equities, so you're buying into the equity market. Do you want to buy into the equity market, or do you want to buy into crypto assets, into that asset class?
Yeah, well, just to clarify, so Digital X, your picks and shovels because you're an ASX listed company,
Absolutely.
right? So you can gain access to the coin. So does Digital X actually have coin on its balance sheet?
We do. We have Bitcoin on our balance sheet. So we are a pick and shovel from that perspective, but we run, like we said, 2 funds as well, 2 wholesale funds. One of which is an active strategy, which a lot of Australians wouldn't be familiar with the fact that there are active strategies out there that are safe as well to invest in rather than going to have to pick the tokens themselves.
Dan, that's not necessarily what you're talking about in picks and shovels, though, is it?
No. I mean, similar, but the picks and shovels that I'm referring to are, in the journey of Cosmos and trying to, deliver this asset class and a financial product. One of the things we looked at are what are the companies that have direct exposure to the Bitcoins and Ethereums, and these are the miners, right? And so one of the things we looked at were, who are the companies, listed companies, so familiar ground, listed companies that mine Bitcoin or mine Ethereum or mine cryptocurrency, and can we create a basket that gives investors, indirect exposure to the coins themselves, but they're also the infrastructure of the business. Now, the business models of the miners will evolve over time, right? Because now I look at these companies as data storage businesses, right? Because what are they doing? They're using electricity, they're mining and supporting the network of the ecosystem and gaining and being rewarded coins for their efforts, right? So investors can actually participate in these companies based on those efforts, right? And they're, from a valuation perspective, it's in simplest terms, how to value a miner is basically what is their energy input to relative to winnings in the coins, and this is the term we use, hash rate, and that's how you basically value a miner. So what we did at Cosmos really was design this pure play exposure to the miners, which gave investors a direct or indirect exposure to the equity, and now, as I'm sure the news is out, we're also now working on being able to deliver the coin itself in a financial product, right?
That's a taste of the conversation we explored earlier in the day. If you want to catch up, head to the ausbiz website and click on the Cracking Crypto tab. That's the show. Thanks for watching.
Cracking Crypto is partnered with City Index. Trade shares, CFDs, Forex, crypto and more with a trusted provider.